The largest banks on Wall Street just made a massive, multi-billion-dollar calculation error. As the world prepared to ring in the year 2026, a desperate mission was unfolding behind the closed doors of the world's most powerful financial institutions. For the last 48 hours of December, the mission was simple but brutal: smash the price of silver at any cost. They wanted to drive the price down before the final yearly candle closed. They wanted to trigger every stop-loss order in the system and break the spirit of the bulls who had held the line throughout the year. For a few hours, it looked like their plan was working. The screens turned red. A wave of selling hit the COMEX, pushing the price of silver down with a violent momentum that felt like a total market collapse. The price plummeted through several support levels, eventually hitting a low of $70.50. To the casual observer, it looked like a crash. It looked like the end of the greatest silver rally in modern history. But as the final hours of 2025 ticked away, something happened that was not in the script of the big banks. The selling stopped dead in its tracks. The price didn't just stabilize. It bounced with a ferocity that caught the short sellers off guard. As we analyze the final daily chart of the year, we see a doji candle. In the world of technical analysis, this is a profound signal of indecision and exhaustion. It means the banks threw everything they had at the market, including the kitchen sink, and the market simply absorbed it. By attempting to smash the price, the banks did not kill the rally. Instead, they unwittingly created the greatest buying opportunity for their biggest competitors. They lowered the price of silver for China. They lowered the price for industrial giants like Samsung and Tesla. They lowered the price for the very entities that are currently draining the physical vaults of the West. Right now, as we sit in the quiet hours of New Year's Day, silver is trading back at $71.83. The recovery from the lows is nearly $1.50. The daily chart now shows a long lower wick, which is a classic sign of rejection. The market looked at the $70 level, tested it, and rejected it as being too cheap. This rejection is happening on the most important day of the year for accounting. It means that despite the tax selling, despite the regulatory flushes, the market is closing the year on a bullish note. The structural integrity of this bull market is not just intact, it has been reinforced. The banks tried to create panic, but instead, they found liquidity. They sold their paper silver to strong hands who have no intention of selling it back. These are physical accumulators who buy on value and move the metal into private vaults, melting it down or using it in industrial processes where it can never be recovered. This was a fatal error for the short sellers. You never want to sell your shorts to strong hands because strong hands do not provide you with an exit. They take the inventory off the exchange forever. The stage is now set for January 2nd. The banks have cleared the decks, but they have left the door wide open for real money to enter. The smash has failed, and the floor is now made of concrete. To understand why the biggest banks in the world would intentionally crash a market they participate in, you have to look past the charts and into the boring, bureaucratic world of international banking regulations. Specifically, we must talk about the GSIB surcharge. GSIB stands for Global Systemically Important Banks. This is a classification created by the Financial Stability Board and the Basel Committee on Banking Supervision following the Great Financial Crisis. It is designed to ensure that banks like JP Morgan, Goldman Sachs, and HSBC do not become too big to fail without paying a steep price. Under the Basel III regulations, these massive institutions are scored on their systemic risk every single year. This score is not an average of their performance over 12 months. Instead, it is a snapshot taken on one specific day, December 31st. The score is calculated based on 5 categories: size, interconnectedness, lack of readily available substitutes, cross-jurisdictional activity, and complexity. If a bank's score exceeds a certain threshold on that final day of the year, they are moved into a higher bucket. Moving up just one bucket can force a bank to hold an extra 0.5% or even 1% of common equity Tier 1 capital. For a bank with a balance sheet in the trillions, this means they must lock away billions of dollars in extra capital for the entirety of the following year. This creates a phenomenon I call a regulatory hallucination. Every year in late December, the largest banks on Wall Street engage in a massive fire sale. They sell off assets, they close out derivative positions, and they shrink their books at all costs. They are not selling silver because they believe the price is going to $60. They are selling silver because they need to appear smaller, leaner, and less risky than they actually are for the regulators. They are essentially dressing the windows of their counting houses to fool the government. This is not a market signal, it is an accounting trick. Yesterday, when you saw silver plummet towards $70, you were not witnessing a change in market fundamentals. You were watching the GSIB liquidity flush in real time. The banks were dumping paper contracts to reduce their complexity scores and their interconnectedness rankings. By crashing the price, they were neutralizing their risk profiles before the midnight deadline. This is a purely non-economic activity. It is driven by lawyers and compliance officers, not by traders or analysts. The banks were willing to take a loss on those trades just to avoid the multi-billion-dollar capital surcharges that would have kicked in on January 1st. But here is the catch that most retail traders completely miss. On January 2nd, the snapshot is over. The regulatory pressure vanishes as soon as the ball drops in Times Square. The banks no longer have an incentive to stay small. In fact, they have every incentive to grow their positions again, to hedge their risks, and to start generating profits for the new fiscal year. This means the massive selling pressure we witnessed over the last 48 hours has a hard expiration date. That date was last night. If you were scared into selling your position because of this artificial drop, you got played by the accounting department of a global investment bank. They didn't beat you with better analysis. They beat you with a calendar. Tomorrow morning, the banks will change their clothes, and the natural forces of supply and demand will take control of the market once again. To understand why the bank error was so significant, you have to look closely at where the selling stopped. The price did not just drift aimlessly. It hit a wall of concrete at $70.50. This was not a coincidence. This specific price level was the major breakout point from several weeks ago. It was the heavy ceiling that had suppressed the market for months. In the world of technical analysis, there is a core principle. Former resistance, once broken, becomes major support. By pushing the price back to $70, the banks were testing the structural integrity of the entire bull market. When the price crashed yesterday, it did not go to $68. It did not go to $65. It stopped dead. This tells us that there is a massive strategic bid sitting right at $70. This bid does not belong to retail traders or nervous speculators. It belongs to the real money. We are talking about industrial buyers, sovereign wealth funds, and central banks who have automated orders to buy every single ounce available at that level. For these entities, $70 silver is a gift. They are not looking at a chart for a quick trade. They are looking at a 10-year supply deficit. The banks tried to push the market lower to trigger a wave of panic selling, but instead of finding panic, they found a vacuum of liquidity. They sold their cheap paper silver into the hands of strong physical accumulators. This is a catastrophic mistake for a short seller. In a healthy market, a short seller wants to cover their position by buying back from weak hands who are selling in fear. But when you sell your contracts to a strong hand at $70, that metal is gone. It is taken off the exchange. It is vaulted. It is used in industrial production for solar panels or high-end electronics. Strong hands do not sell back to the banks when the price bounces. They are the final destination for the metal. By driving the price to the $70 floor, the banks actually accelerated the drain of the physical inventory. They made it cheaper and easier for the rest of the world to take the metal away from them. This is why the volume profile of the recovery is so important. We saw high volume on the way down, representing the forced liquidation and the bank manipulation. But the bounce back to $71.83 has been steady and constructive. This is the hallmark of quiet accumulation. As long as silver remains above the $70 mark, the technical damage to the chart is nothing more than a flesh wound. The long-term bullish trend on the monthly and yearly charts remains perfectly intact. In fact, by successfully defending this level, the market has proven that $70 is the new undisputed floor for the year 2026. The banks attempted to break the market's spirit, but they ended up confirming its strength. They have essentially de-risked the entry for every major fund that was waiting for a retest of the breakout. The trap has failed, and the foundation for the next leg up is now more solid than it has ever been. While the drama was unfolding on the New York COMEX, the real story was being told thousands of miles away in the east. To find the truth in the silver market, you must look at the Shanghai Gold Exchange. This is the smoking gun that proves the New York price smash was a localized, paper-driven manipulation rather than a shift in global demand. While New York was screaming toward $70, the price action in Shanghai told a completely different story. Yes, the Shanghai price did drop. It fell from $82 to a low of $75.58. On the surface, it looked like a global sell-off. But when you look closely at the spread, the reality is staggering. At the exact moment silver was trading at $71.83 in the United States, it was trading at $75.58 in China. This is a difference of nearly $4 per ounce. Even after a massive global correction, silver is still significantly more expensive in the East than it is in the West. This is what we call a persistent arbitrage gap, and right now, it is wide enough to drive a freight train through. In a functional, efficient market, the price of a global commodity like silver should be nearly identical in every city after accounting for shipping and insurance. But the $4 premium in Shanghai is a signal of extreme physical tightness. It means that despite the paper selling in New York, The physical buyers in China are refusing to let the metal go for cheap. They are screaming for physical delivery, and they are willing to pay a massive premium to get it. This creates a powerful vacuum effect. As long as this premium exists, the floor under the United States price is made of steel. The arbitrage bots and international trading houses are incentivized to buy silver at $71 in New York, take physical delivery, and ship it to Shanghai to sell it for $75. This is a guaranteed profit. This constant drain of metal from west to east is the ultimate nightmare for Western banks. They can smash the paper price all they want, but they cannot smash the physical reality that the world's largest manufacturing hub needs this metal and is willing to pay more for it. We must understand that China is not just a speculator in this market. They are the end consumer. They need silver for their massive solar energy infrastructure, their electric vehicle production, and their domestic electronics industry. By smashing the New York price to $70, the Western banks essentially gave China a $4 discount on every ounce they could get their hands on. It was a strategic gift to their greatest economic rival. The banks moved the metal from their own vaults into the vaults of the East at a subsidized price. As we move into the first week of January, this disconnect will likely force the New York price to play catch-up. The paper market is being forced to accept the reality of the physical world, and that reality is being dictated by the buyers in Shanghai. To understand the resilience of silver, we must look at its big brother, gold. Throughout the recent volatility, gold has acted as the ultimate monetary anchor. While silver was swinging wildly, dropping 10% in a matter of hours, gold remained a rock. Gold is currently trading at $4,346. It is down only marginally from its highs, refusing to break its own critical support levels. This tells us that the global monetary premium remains extremely active. The world is still deeply concerned about sovereign debt, currency debasement, and the instability of the fiat system. The big players, the central banks, and sovereign wealth funds are not selling their insurance. They are holding their gold with white-knuckle intensity. Because gold is holding the line, silver has a safety net. Silver is often referred to as a high-beta version of gold. It moves in the same direction, but with much greater velocity and volatility. This is the nature of the beast. However, the gold-to-silver ratio acts as a tether that prevents silver from collapsing too far. If silver were to drop significantly lower, while gold remained at $4,300, the gold-to-silver ratio would expand to an irrational level. At that point, the sophisticated algorithmic bots that manage trillions of dollars would automatically sell gold to buy silver. This creates a natural rebalancing mechanism that supports the silver price. Gold is acting as the protector, shielding its smaller, more volatile sibling from the predatory attacks of the short sellers. The fact that gold refused to buckle during the year-end G-SIB flush is a massive green flag for the precious metals sector. It proves that the liquidation was concentrated in the highly leveraged paper markets of silver rather than a broad-based rejection of hard assets. Smart money is stepping in and picking up silver contracts at $71 because they see the value gap between the two metals. They are building positions for the new year, recognizing that silver is the undervalued play in a world where gold is setting record highs. This quiet accumulation by the smart money is often more bullish than a sudden, noisy price spike. It indicates that the weak hands have been successfully flushed out, and the inventory is moving into the hands of those who understand the long-term macro picture. As we enter the first trading days of 2026, the stability of gold will provide the confidence necessary for silver to launch its next rally. The anchor is set, the floor is firm, and the upward trajectory remains the path of least resistance. While the banks were catching their breath after the G-SIB squeeze, a new giant was waking up, the pension funds. We have entered the window of the January effect, a seasonal anomaly where asset prices tend to rise in the first month of the year. But for silver in 2026, this is not just a statistical curiosity. It is a mechanical certainty driven by the movement of trillions of dollars in institutional capital. The calendar year of 2025 has officially closed, and the data is final. Silver was the best performing asset class of the year, dramatically outperforming the S&P 500 bonds and real estate. In the world of institutional investing, performance creates a mandate. Pension funds, endowments, and sovereign wealth funds operate under strict rules of fiduciary duty and asset allocation. When fund managers return to their offices on January 2nd, they are looking at a leaderboard that shows silver at the very top. The question they must answer is simple. Do we own enough of the winner? For most large institutions, the answer is a resounding no. Most pension funds have zero direct exposure to physical silver or silver-backed ETFs. As the new fiscal year begins, these funds receive fresh allocations of capital. This is new money that must be deployed according to their strategic mandates. We are about to witness the great rebalancing. Institutional buying is fundamentally different from the bank short covering we saw yesterday. When a bank buys, they are often just neutralizing a position closing a short. But when a pension fund buys, they are opening a long position. They are accumulators. They buy large blocks of silver or silver equities and lock them away in a vault for 10 years. This removes the float from the market. This type of buying creates a sustained upward pressure that cannot be easily reversed by paper manipulation. Furthermore, the tax loss selling that plagued the mining sector in late December has vanished. In December, investors sold their losing positions to book capital losses for tax purposes. Today, that incentive has flipped. Investors have a fresh tax year ahead of them, allowing them to buy with a clean slate. When you combine the end of bank shorting, the start of institutional accumulation, and the reversal of tax loss selling, you get a 1-2-3 punch that can send the price of silver vertical. The path of least resistance is now wide open. The weak hands have been shaken out, the regulators have taken their snapshot, and the biggest pools of capital on the planet are now looking to buy the one asset that proved its strength during the year-end chaos. The January effect is about to transition from a theory into a reality that will define the first quarter of 2026. While the paper markets in New York and London are fixated on digits on a screen, the physical world is facing a brutal reality. We are running out of silver. As we enter 2026, the global silver market is not just in a deficit, it is entering a state of acute structural stress. For 5 consecutive years, the world has consumed more silver than it has produced. In 2025 alone, the estimated deficit exceeded 200 million ounces. This is not a rounding error. It is a shortfall equivalent to the entire annual output of Mexico, the world's largest silver producer. The strain is now visible in the vault statistics of the major exchanges. Registered inventories at the COMEX have plummeted by nearly 70% from their peaks, while London Bullion Market Association vaults have seen their free float inventory metal not already tied up in ETFs or industrial contracts collapse to historic lows. In Shanghai, stocks are reportedly at a 10-year bottom. The buffer of above-ground silver that has suppressed prices for decades is effectively gone. We are moving from a market of abundance to a market of extreme scarcity. The reason this vacuum is so dangerous for the short sellers is the nature of silver demand. Unlike gold, which is primarily held as a store of value, more than 50% of annual silver demand comes from industrial applications. Silver is the most electrically and thermally conductive metal on Earth. It is an essential, non-substitutable component in the green energy transition. The solar photovoltaic sector now accounts for nearly 30% of all industrial silver use. As the world races to meet clean energy mandates, solar installations are expanding at a rate that mine supply simply cannot match. Furthermore, the automotive industry is undergoing a massive technological shift. An electric vehicle requires between 25 and 50 grams of silver, roughly double the amount used in a traditional internal combustion engine. From battery management systems to high-power fast chargers, silver is the nervous system of the modern EV. Add to this the explosive growth of artificial intelligence in data centers, which require massive amounts of silver for high-end semiconductors and electrical contacts, and you have a recipe for a supply chain crisis. The banks and the regulators can manipulate the paper price of silver to meet year-end accounting goals, but they cannot manufacture silver out of thin air. When companies like Samsung, Tesla, or Apple need silver for their production lines, they do not care about the G-SIB surcharge or the technical chart patterns. They need the physical metal to keep their factories running. In 2026, we expect to see force majeure events where suppliers are unable to fulfill physical contracts. When the industrial giants realize there is no metal left at $70, they will be forced to bid the price up to whatever level is necessary to secure their supply. This is the definition of a physical squeeze, and it is the primary reason why $75 is not the ceiling, but rather the launch pad for the next move higher. While physical silver has been setting the world on fire, the companies that pull it out of the ground have been behaving like a coiled spring. We are witnessing one of the most profound valuation disconnects in history between the metal and the miners. Historically, when silver enters a bull market, the mining stocks act as a leverage play. Because they have fixed operating costs, every dollar increase in the spot price falls straight to their bottom line, often resulting in a 3-to-1 or 4-to-1 outperformance relative to the metal. But as we enter January 2026, the miners are lagging behind. Let's look at the numbers. At $75 an ounce, silver mining has become one of the most profitable businesses on the planet. For industry leaders like Hecla Mining and Core Mining, their all-in sustaining costs often hover between $15 and $25 per ounce. This means at current levels, these companies are generating $50 of pure profit for every ounce they produce. In the third quarter of 2025, Hecla reported a record-breaking performance with a realized silver price of only $42. Now that we are north of $70, their free cash flow is set to explode. We are talking about potential free cash flow yields of 20 to 30%, levels that are unheard of in the broader S&P 500. So why are the stocks lagging? The answer lies in the institutional memory of the last decade. Generalist investors, the big funds that manage trillions, have been absent from the mining sector for years. They remember the lean times and the mismanagement of the past. But this skepticism is the retail investor's greatest advantage. As silver stabilizes above $70, these generalist funds will be forced to look for ways to play the silver boom. They will quickly realize that they cannot buy billions of dollars worth of physical coins without moving the market, so they will turn to the equity market. When that wall of institutional money hits the tiny silver mining sector, the impact will be like a tidal wave hitting a bathtub. The total market capitalization of the entire silver mining industry is smaller than many individual tech stocks. A small rotation from a giant pension fund can double the price of a mid-tier miner in a matter of weeks. We saw a preview of this volatility yesterday. When the metal crashed, the miners crashed harder, but today they are flying, outperforming the recovery of the spot price. This is the catch-up trade of January. The secret that the market hasn't priced in yet is that these companies are no longer just miners. They are cash-generating machines. Companies like Hecla are using this windfall to deleverage their balance sheets and return massive amounts of capital to shareholders through dividends and buybacks. In a world where tech stocks are trading at 40 times earnings, silver miners at current metal prices are trading at single-digit multiples of their projected free cash flow. This is the ultimate asymmetric bet for 2026. You are buying a highly profitable, essential industrial business at a discount. With a free call option on silver hitting $100, the year 2025 closed with a definitive message: the sellers are gone. When an asset like silver closes at its yearly high, it enters a phase known as a blue sky breakout. In this territory, there is no overhead supply. There are no investors waiting to get their money back at $80 because the price has never been there before. Everyone who owns silver is currently in profit. This creates a psychological environment where holders become reluctant to sell, wanting to see just how high this rally can go. To navigate this uncharted space, professional analysts use Fibonacci extensions to map out potential targets. By measuring the primary move from the breakout at $50 to the consolidation at $65, we can identify where the next major algorithmic pauses might occur. The first significant target is the 1.272 extension, which lands squarely at $85.87. This is not just a random number. It is a level where the automated trading programs used by massive hedge funds are likely to take their first breath and lock in some gains. However, in a runaway market, also called a parabolic move, technical resistance often acts as nothing more than a speed bump. When fear of missing out, or FOMO, takes over, the market tends to ignore minor extensions and head straight for the big psychological magnet, the triple-digit mark of $100. We are already seeing signs of extreme retail interest. Google searches for how to buy silver are spiking, and trading volume is becoming vertical. Unlike the banks, the public does not buy to hedge, they buy to hold. They bury their silver in the backyard or lock it in private safes, effectively removing it from circulation and tightening the squeeze even further. But I would be irresponsible if I did not mention the danger zones. The banks took a multi-billion-dollar beating in December, and they are now like wounded animals. Wounded animals are dangerous. In the first weeks of January, we may see them attempt to reshort the market, trying to create a double top pattern to shake out the latecomers who bought at the peak of the momentum. If they succeed, we could see a sharp, scary correction back to the $70 floor. Yet, this reshort strategy is likely doomed to fail because of the physical vacuum we discussed earlier. You cannot successfully short a market when there is no physical inventory left to deliver. Any attempt to crash the price will simply be met by arbitrage bots and industrial buyers who will demand delivery of the very metal the banks do not have. This creates a prisoner's dilemma for Wall Street. If they attack the price, they lose their remaining metal. If they do nothing, they lose their money. As we head into the first trading week of 2026, the target remains clear. $85 is the technical objective, but $100 is the psychological destination. The regulatory squeeze of December 31st was not an ending. It was the catalyst for a new era in the silver market. As we stand at the threshold of 2026, it is vital to remember that the battle for price discovery is just beginning. When the opening bell rings on January 2nd, the world will find out just how little silver is actually left for sale. But as an investor, your greatest challenge will not be the banks or the regulators. Your greatest challenge will be your own psychology. It is easy to buy an asset when it is rising, but it is incredibly hard to hold it when you are sitting on life-changing gains. When silver hits $80, you will feel like a genius. When it hits $90, you will feel invincible. But when it inevitably experiences a sharp correction back to $80, you will feel like a fool for not selling. To survive this volatility, you must detach your self-worth from the daily fluctuations of the price. You are not a genius when it goes up, and you are not a fool when it goes down. You are a custodian. You are holding a strategic, non-substitutable asset that the entire modern world requires to function. Your job is simply to keep it safe until the market offers you fair value. And what is fair value? Fair value is not measured in depreciating paper dollars. It is measured in what those ounces can buy in the real world. Ask yourself, can I buy a home for my family with my silver stack? Can I buy a productive farm that provides for my children? If the answer is not yet, then the trade is not over. Do not sell for lifestyle money, the kind of money that buys a temporary luxury. Instead, aim for dynastic wealth. We are talking about the kind of wealth that changes the trajectory of your family for generations. Silver is one of the few assets in history that has the potential to perform this kind of wealth transfer. The banks tried to use a regulatory loophole to steal your position at $70. They failed. They are now trapped in a cycle of rising demand and disappearing supply. The verdict is clear. The trend is up, the fundamentals are screaming, and the technical setup for the first quarter of 2026 is statistically perfect. Enjoy your New Year's Day. Celebrate with your family and reflect on the foresight that brought you to this position. But stay sharp. When the market opens tomorrow, the January effect begins, and the year of the squeeze truly takes flight. You were early, you were right, and now you are ready.